Have you ever paused, late at night, and wondered, truly wondered, where your money goes when you place it into that vast, marble-floored institution on the corner of Main Street? Perhaps you have, in those quiet moments before sleep overtakes you, considered the simple yet profoundly complex question of trust. Where, exactly, does your money rest when it is no longer in your pocket, no longer in your wallet, no longer in your immediate grasp? This question, gentle as evening moonlight, has haunted the minds of ordinary people for nearly 2 centuries. And tonight, as you settle into the comfort of this narrative, we shall explore together, slowly and methodically, the intricate paths your currency takes, the invisible hands that guide it, and the remarkably boring yet utterly fascinating mechanisms that keep the entire system functioning. Consider, if you will, the act of depositing money itself. You walk through those heavy wooden doors, perhaps glass and brass doors in modern establishments, and you hand over a bundle of paper and metal to a person sitting behind a desk. They smile, they take the money, they type some numbers into a computer, and suddenly, there is a number on a screen that represents your wealth. But is your money actually there? Is it sitting in a vault, physically present, waiting for you to return? Or has it transformed into something else entirely? The answer, you see, is far more nuanced, far more layered, and far more deeply fascinating than you might have previously imagined. As we journey deeper into this night, into the very heart of banking itself, you will come to understand the mechanisms, the regulations, the hopes and fears that underpin every single financial transaction you have ever made. You will discover that the institutions holding your money are not mystical, not unknowable, but rather bound by laws, by customs, by traditions that stretch back through centuries of human civilization. And perhaps by the end of our conversation, you will find yourself not worried, but rather reassured, comforted even, because the system, despite its complexity, despite its seeming opacity, is designed with a certain care, a certain consideration for the ordinary person such as yourself. So let your mind drift, let your shoulders relax, and allow yourself to sink deeper into the comfortable cushions of this chair, as we explore together the answer to that most gentle of questions: where, exactly, does your money really go? Before we delve into the contemporary mechanics of banking, it would be wise, it would be proper, to understand the history from which all of this emerged. You see, the very concept of placing your money into someone else's care, into the protection of an institution, is not a modern invention. It stretches back through the fog of centuries, to times when merchants in ancient Mesopotamia would leave their grain with storekeepers, trusting that it would remain safe, that it would be returned to them in equal measure. And in those early days, before regulated banks existed as they do now, before the words Federal Deposit Insurance Corporation meant anything to anyone, people faced a simple, primal fear. The fear of loss. The fear that their savings, their accumulated wealth, their future security, would simply vanish into the ether, stolen or mismanaged or destroyed by forces beyond their control. This fear was not irrational. It was, in fact, quite reasonable. Throughout history, people lost their savings regularly. Banks failed. Vaults were raided. Economies collapsed, and the money in those vaults became worthless paper. It was only in the relatively recent past, in the 20th century, that societies began to construct systems, regulatory frameworks, and insurance mechanisms designed specifically to ease this ancient anxiety. The modern bank, as you know it today, evolved gradually from these older institutions. Medieval money changers, Renaissance bankers in Florence and Venice, the great banking houses of Europe, they all contributed to the slow development of trust and standardization. And then, as the United States of America grew and expanded, as railroads and industries and commerce spread across the vast continent, there arose a need for a more organized, more reliable banking system. The individual could no longer simply hide their wealth beneath their floorboards, or bury it in the garden, or trust it to a local merchant. The scale of the economy required something more formal, more structured, more institutional. And so the banking system as you know it today was born, not fully formed, not without flaw, but rather gradually, through accumulated experience, through trial and error, through economic booms and catastrophic depressions. The fear, however, did not disappear. It merely transformed. It evolved. It became the motivating force behind regulatory bodies, insurance programs, and the vast infrastructure of rules and safeguards that surrounds your money even as you sleep. Understanding this history, this journey from fear to relative safety, is essential to understanding the present. Imagine, if you will, walking through the doors of a bank on a morning in 1950. The heavy doors would creak slightly as they closed behind you, sealing you within a space of profound solidity. The floors would likely be marble or polished granite, cool beneath your feet. The walls would rise upward, substantial and thick, built to last not just years, but generations. In many older bank buildings still standing today, those walls are constructed of stones so densely packed, so carefully mortared, that they seem less like human constructions and more like natural formations, ancient cliffs transported to the center of the city. And somewhere within this building, deeper perhaps than the basements of nearby buildings, deeper sometimes than the bedrock beneath the street itself, would lie the vault. The vault. That sacred, that profoundly important chamber, sealed with locks of astronomical complexity, defended with the most sophisticated security measures that the engineering of the era could produce. In the early 20th century, bank vault doors were mechanical masterpieces. Thick steel mechanisms with multiple tumblers that required simultaneous turning by different people at different times, ensuring that no single individual could gain access. The very thickness of these doors, the weight of them, the difficulty of opening them even with the correct keys, these physical realities were meant to communicate something profound to the customer. Your money, they seem to say, is so safe here that we have quite literally surrounded it with tons of steel and stone. Modern vaults have evolved beyond these mechanical wonders into systems involving electronic locks, biometric scanners, time-delayed mechanisms that prevent the door from opening before a certain hour, and multiple redundancies that would require an almost impossible combination of circumstances to bypass. Yet the principle remains the same. The physical separation of the vault, its isolation from the outside world, its apparent impenetrability, all serve a psychological purpose as well as a practical one. When you deposit your money, you are not just transferring it to a storage space. You are, in a very real sense, placing it into a fortress. A fortress that has been designed, constructed, and maintained by individuals who have dedicated their professional lives to the single purpose of protecting your wealth. The architecture itself, whether the ornate stone and brass of older buildings or the sleek concrete and steel of modern ones, communicates this dedication. Every angle, every surface, every seemingly excessive thickness of wall or door, these are all choices made deliberately, purposefully, to create and maintain an environment in which your money can rest securely. Now let us turn our attention to the checking account, that fundamental tool of modern life that so many of you utilize without truly understanding its origins, its purpose, or its elegant simplicity. The checking account, in its essence, is one of humanity's most ingenious financial inventions, though it is so commonplace, so woven into the fabric of daily existence, that we rarely pause to appreciate its brilliance. The history of the checking account stretches back to medieval times, when merchants in Europe first began using promissory notes. A merchant in one city could give another merchant a written promise that the second merchant's bank would pay the bearer of that note a certain sum of money. This note could then be carried, traded, exchanged, without the physical transfer of coins or precious metals. It was a way of solving a very practical problem. How do you safely move large amounts of value across distances without actually having to transport chests of gold? The modern checking account evolved from this concept. Instead of the merchant's promissory note, we have the personal check. And the checking account, maintained by a bank in your name, serves as the repository against which those checks are drawn. When you write a check to pay your landlord, to purchase groceries, to settle a debt, you are essentially writing your own promissory note backed by the bank's promise that it will honor your written instruction, provided that your account contains sufficient funds. The bank, in creating your checking account, has made a promise to you. They promise that when you deposit money, they will keep a record of that deposit. They promise that when you write a check, they will deduct the appropriate amount from your account, and they promise that they will not overdraw your account without your knowledge or explicit permission. This system, This intricate dance of promises and records, of deposits and withdrawals, of checks written and checks cleared, has been refined over more than a century into a remarkably reliable system. Your checking account, the one you perhaps glance at on your computer screen or phone, is the direct descendant of those early promissory notes. It serves the exact same purpose, merely implemented through more modern technology. The number on the screen, that digital representation of your wealth, is backed by the bank's commitment to honor your requests for withdrawal. The check is now processed electronically, cleared not by physical transportation of papers but by digital transfer of information between banks. Yet the fundamental principle remains unchanged. Your checking account is your personal financial command center, the place from which you direct the flow of your money through your daily life. In modern times, your checking account exists primarily as a digital abstraction. You likely rarely write checks anymore. Instead, you use debit cards, electronic transfers, automatic payment systems, and digital wallets to access the funds in your checking account. The physical checkbook, once the primary tool of account access, sits largely unused in a drawer or a closet, gathering dust like a relic from a previous era. Yet the account itself remains central to your financial life. It is the primary conduit through which your income flows, the foundation upon which your ability to pay bills, to purchase goods, to live your daily life is constructed. And here is where a certain complexity arises, where the straightforward elegance of the checking account becomes entangled with modern business practices and regulatory realities. When you open a checking account at a bank, that bank typically offers you what they describe as a free checking account. The word free appears in their advertisements, their television commercials, their marketing materials. Yet the account is not truly free. Rather, it operates under a set of conditions, a hidden economy, a system of charges and fees that become apparent only when you read the lengthy terms and conditions. Those documents often written in such technical language and presented in such small print that the average person can scarcely comprehend them. The bank does not charge you a monthly fee for the account itself, this is true. But the bank does charge you fees for various services and circumstances. If you withdraw money from an ATM that is not owned by your bank, you may incur a fee. If you exceed a certain number of electronic withdrawals in a month, you may incur a fee. If your account balance falls below a certain minimum, you may incur a fee. And if you somehow manage to overdraw your account, to spend more money than you possess, the bank may charge you a substantial overdraft fee, sometimes many dollars, for the privilege of that temporary shortfall. These fees, though individually small, accumulate over time, transforming the supposedly free account into a moderate ongoing expense. The bank, in this system, receives what economists call the float. The float is the benefit the bank obtains from having access to your money, even temporarily. When you deposit a check, the bank does not immediately pay you the full value of that check. Instead, they credit your account, but they hold the physical check for a certain period, sometimes days, during which they have access to that money. If you deposit $1,000 on a Monday, the bank may not clear that check until Wednesday. For those 2 days, the bank can invest your $1,000, or loan it out, or use it in any other way they see fit, and they keep any interest or returns that it generates. This is the compensation the bank receives for providing the service of maintaining your account. Over millions of accounts, over billions of transactions, the float represents a significant source of income for banks, even though individual customers rarely think about it. This is the hidden economy of the checking account, the mechanism by which banks profit while appearing to provide the service freely. Whereas the checking account is designed for movement, for the constant flow of money in and out, the savings account serves an entirely different purpose. The savings account is built, fundamentally, on the concept of delay. It is designed for money that you wish to accumulate, that you intend to keep relatively untouched, that you are preserving for future needs or future goals. When you open a savings account, you are essentially making a different kind of agreement with your bank than you do with a checking account. You are saying, in effect, I am placing money with you. I do not plan to access this money frequently. In exchange for this stability, for this promise that my money will remain here relatively undisturbed, I expect compensation. And that compensation arrives in the form of interest. Interest is perhaps one of the most ancient and complex concepts in all of economics. It is simultaneously one of the simplest ideas, that money has a cost and a value, that borrowing money should require payment beyond the principal, and one of the most deeply layered and sophisticated concepts that financial systems have ever produced. The interest paid on a savings account is calculated as a percentage of your balance, expressed as an annual rate. So if you maintain $1,000 in a savings account that offers 1% annual interest, you will earn $10 in interest over the course of a year, assuming that you do not withdraw any of the principal. That $10, come the new year, will be added to your account balance, bringing it to $1,010. This is remarkably simple arithmetic, yet it contains within it a beautiful power, the power that Einstein allegedly described as the eighth wonder of the world, compound interest. For in the following year, you will not earn interest merely on your original $1,000. You will earn interest on $1,010. The interest earns interest. The growth accelerates slowly, imperceptibly at first, but with accumulated power over years and decades. $1,000 at 1% annual interest, left untouched for 50 years, becomes $1,600 and something dollars. It does not seem like much. Yet that growth occurred with no effort on your part, through no work or sacrifice, merely through the passage of time and the miracle of compounding. The savings account, then, is not designed to make you wealthy. It is designed to preserve your wealth, to protect it against inflation, to allow it to grow incrementally and steadily. The money in your savings account is not doing nothing, even though it may feel that way. It is being held in trust, kept safe, and gradually, quietly increasing, waiting for the day when you may need it. Now we arrive at a topic that, while it may seem purely mathematical, is actually the heartbeat of the entire banking system. Interest rates. These percentages, these seemingly small numbers, drive the entire machinery of modern finance. To understand why banks care so deeply about interest rates, why central banks spend decades studying them, why entire governments orient their policies around them, one must understand what interest rates truly represent. Interest rates, at their most fundamental, represent the value of borrowed money. When you borrow $100 and are asked to repay $105, the $5 represents the interest, and the 5% figure represents the interest rate. That 5% is the price of using someone else's money for a period of time. Now, banks operate on a remarkably simple principle, a principle so basic that it is almost embarrassing to state, yet it is the foundation of everything they do. Banks borrow money from you, in the form of your deposits. When you place money in a savings account, you are technically lending that money to the bank. The bank promises to return that money to you whenever you request it, with modest interest. The bank then takes that money, that pool of deposits from thousands or millions of customers, and loans it out to other customers who need it. A homebuyer borrows $500,000 to purchase a house, paying an interest rate of 5%. A small business borrows $100,000 to expand, paying an interest rate of 6%. The bank collects these higher interest rates from its borrowers, and pays lower interest rates to its depositors, keeping the difference as profit. This difference is called the spread. If the bank is paying you 1% on your savings account, but charging homebuyers 5% on their mortgages, the spread is 4%. Across all the bank's customers, across all the money flowing through the system, that 4% spread becomes substantial, becomes significant, becomes the fuel that keeps the bank operating and profitable. Banks care deeply about interest rates because the relationship between the rates they pay to depositors and the rates they charge to borrowers determines their profitability. If interest rates rise in the economy broadly, if the Federal Reserve, the central bank of the United States, increases its benchmark rate, banks must raise the interest they pay to deposits in order to remain competitive with other banks. Simultaneously, the interest rates banks can charge borrowers tend to rise as well. The spread between borrowing and lending rates may remain relatively stable, but the absolute magnitude of the interest changes. You should care about interest rates for different reasons. Higher interest rates on savings accounts mean that your money grows faster, that your delayed gratification is rewarded more generously. Higher interest rates on mortgages mean that the houses you might purchase become more expensive to borrow for. Interest rates, these seemingly abstract numbers, affect everything about your financial life in profound and direct ways. Let us now spend some time, comfortable time, meditative time, exploring the mathematics of compound interest. Not in a way that will challenge you or force your mind to work too hard, but rather in a way that will allow you to drift alongside the numbers, to understand them almost the way you might understand the gentle unfolding of a flower, petal by petal, through the days of spring. Imagine that you have exactly $10,000. You place this sum into a savings account that offers 4% annual interest. This is not an extraordinarily high rate, but it is respectable, a reasonable rate in certain economic environments. In the first year, your $10,000 earns $400 in interest. You now have $10,400. In the second year, this new total earns 4%. 4% of $10,400 is $416. Your balance is now $10,816. You see how the interest itself grows? In the first year, you earn $400. In the second year, you earn $416. The difference seems small, a mere $16, yet that $16 is interest earned on the interest you earned in the previous year. It is the ghost of a return, the echo of your earlier earnings, creating new earnings of their own. In the fifth year, if you continue to deposit no additional money and withdraw nothing, your balance will be approximately $12,166. The $10,000 has grown to $12,000. That is a 21% increase. The growth is accelerating. By the 10th year, the balance will be approximately $14,774. By the 20th year, approximately $21,900. By the 30th year, approximately $32,400. The growth, at first almost imperceptible, begins to accelerate in a way that becomes genuinely remarkable. Your initial $10,000 has more than tripled. And what have you done to earn this tripling? Nothing. You deposited the money. Time passed. The interest compounded. And the bank kept its promise to compensate you for the use of your money. This is the power of compound interest, the power of time working for you rather than against you. The longer you leave your money untouched, the greater the benefit of compounding becomes. It is why financial advisors so frequently tell young people to begin saving as early as possible. Not because your early contributions will be enormous, but because they will have decades upon decades to compound, to grow, to accumulate upon themselves. A single $1,000 placed in an account at age 25, left untouched until age 65, earning 4% annually, becomes $6,700. That contribution of $1,000 has grown to nearly 7 times its original size, purely through the passage of time and the mechanism of compounding. This is not magic. It is mathematics. But it is a mathematics so elegant, so powerful, that it feels almost magical in its effects. We have now arrived at perhaps one of the most important yet least understood topics in all of banking, a topic so crucial that understanding it will fundamentally transform how you feel about the safety of your deposits. We speak now of the Federal Deposit Insurance Corporation, commonly abbreviated as the FDIC. The FDIC is a United States government agency created in 1933 in response to a particular moment of crisis and catastrophe in American financial history. To understand why the FDIC exists, we must travel back nearly a century, to the years immediately following the stock market crash of 1929, to the Great Depression. In those dark years, when the American economy contracted, when businesses failed, when unemployment reached depths that contemporary people found almost incomprehensible, the banking system collapsed alongside everything else. Banks failed by the thousands. Not in small numbers, not gradually, but in cascading waves of failure. The bank your grandmother trusted with her life savings suddenly closed its doors. The deposits vanished. The money was gone, simply gone, as if it had never existed. There were no safeguards. There was no insurance. If a bank failed, your money failed with it. You would recover perhaps a portion of it, in the form of whatever remained after the bank's assets were liquidated, but more often you would recover nothing. Entire families lost their savings. Elderly people who had spent decades accumulating modest fortunes found themselves suddenly destitute. The fear, the desperation, the loss of confidence in the banking system was nearly total. People began removing their money from banks and keeping it at home, which only made the bank's situations worse. And so, in the depths of that depression, the government made a choice. A choice born of necessity, born of desperation, born of the recognition that something had to be done to restore confidence and prevent future catastrophes. The Federal Deposit Insurance Corporation was created. Its mission was simple, though its implementation was complex. The FDIC would insure deposits held in member banks. If a bank failed, the FDIC would repay depositors up to a certain limit, currently $250,000 per depositor per bank. This insurance was not free. Banks paid, and continued to pay, insurance premiums to the FDIC. Those premiums, accumulated in a reserve fund, allowed the FDIC to make good on its promise whenever a member bank fails. The FDIC promised the American people that their money, up to a certain amount, was safe. Safe from the greed of bankers. Safe from market fluctuations. Safe from economic collapse. Safe from the failure of the institution itself. And in the decades since the FDIC's creation, that promise has been kept. When banks fail, as they occasionally do, the FDIC steps in. Deposits are protected. People are repaid. The crisis is managed in an orderly, structured manner rather than erupting into panic and chaos. The FDIC has become, though many people do not realize it, one of the most important safety nets in the entire American financial system. Let us now explore the specific details of FDIC protection, the particulars that ensure you understand precisely how your money is protected, and to what extent. It is important to be precise here, for while the FDIC provides remarkable protection, that protection has boundaries, and understanding those boundaries is essential to managing your deposits wisely. The FDIC insures deposits up to $250,000 per depositor per insured bank. This means that if you have $250,000 in a checking account at Bank A, every single dollar is protected. If Bank A were to fail tomorrow, you would receive the full $250,000. However, if you have $300,000 in a checking account at the same bank, only $250,000 would be protected. The remaining $50,000 would be treated as a claim against the bank's remaining assets, and you might recover some portion of it, or none at all, depending on the bank's financial situation at the time of failure. The key word here is per bank. This is important. If you deposit $250,000 at Bank A and another $250,000 at Bank B, both deposits are fully insured. The FDIC coverage is per depositor per institution. You might think that this limit is outdated, that modern account balances often exceed $250,000, and you would be correct. For very wealthy individuals, this limit presents a genuine challenge. They must either distribute their deposits across multiple banks, or accept that some portion of their funds will not be protected by FDIC insurance. However, for the overwhelming majority of Americans, for the ordinary person living an ordinary financial life, the $250,000 limit is more than adequate. The average American household has far less than this in savings. For these people, FDIC protection is essentially complete. Their money is safe. Beyond the basic coverage, the FDIC provides what it calls special categories of coverage. Certain types of accounts receive separate coverage up to an additional $250,000. A joint account, where two people have equal rights to the funds, is covered separately from either individual's personal accounts. So if you maintain a personal account with $250,000, and a joint account with your spouse also containing $250,000, both are fully protected, for a total of $500,000 of coverage. Retirement accounts, such as IRA accounts, also receive separate coverage. So a traditional IRA with $250,000 is covered separately from any checking or savings accounts you maintain. This complexity exists because the FDIC recognized that people hold money in accounts for different purposes. The joint account is intended to serve the needs of a household. The IRA is intended for retirement saving. The personal checking account is for daily expenses. By providing separate coverage for these different purposes, the FDIC ensures that families and individuals can organize their finances without fear of exceeding coverage limits. The FDIC's insurance is automatic. You do not need to apply for it. You do not need to pay for it directly. The moment you deposit your money in an insured bank, you are covered. The bank pays insurance premiums, which are calculated as a small percentage of the bank's deposits. These premiums are included in the bank's operating costs, which influence the fees and interest rates the bank charges its customers. So in a sense, you are paying for FDIC insurance indirectly, through slightly lower interest rates or slightly higher fees. But this is a small price for the security and peace of mind that FDIC insurance provides. Now we arrive at a topic that, while considerably less dramatic than the history of bank failures or the mechanics of FDIC insurance, is in many ways far more relevant to your day-to-day financial life. We speak now of fees. Hidden fees. The small, seemingly insignificant charges that accumulate across months and years, slowly, almost imperceptibly, draining resources from your account without your constant awareness. These fees are perhaps the most honest way that banks generate revenue from what they describe as free checking. They are, in a certain sense, more honest than the float, the invisible profit banks generate from access to your deposits. Because fees are explicit, disclosed in writing, though often in fine print that few people read thoroughly. Let us enumerate some of the most common fees that banks charge their customers. First, there is the overdraft fee. This is perhaps the most egregious and the most profitable for banks. An overdraft occurs when you attempt to withdraw more money than you currently have in your account. In the days before electronic banking, this was a rare occurrence, something that would require special permission from the bank. But in modern times, with debit cards, ATM withdrawals, and electronic payments all moving quickly, it is remarkably easy to accidentally overdraw your account. Many banks, attempting to be helpful, will allow the transaction to go through even if your balance would fall below zero. For this service, they charge an overdraft fee. This fee is often quite substantial, sometimes $30 or more per overdraft incident. Now imagine a person who is living paycheck to paycheck, someone who has just enough money to cover their monthly expenses with perhaps $50 left over. A single overdraft, perhaps a payment processed slightly early, could cost them $30 in fees. That is a significant portion of their financial cushion, consumed instantly, without any service having been provided beyond the permission to spend money they did not have. Over the course of a year, if a person has 3 overdrafts, they have paid $90 in fees, purely because they miscalculated their balance. That $90 might have represented meals, medication, or other necessities. The overdraft fee is profitable for banks because it is unpredictable, surprising, and it hits people when they are already financially stressed. Then there's the insufficient funds fee, which is charged when you attempt a transaction and your account does not contain sufficient funds, even if the bank does not permit the transaction to go through. You attempt to write a check, but there is insufficient balance. The bank charges you a fee for the attempt itself. Next come the ATM fees. If you use an automated teller machine that is not owned by your bank may charge you a fee, typically $1 to $3 per transaction. Additionally, the other bank that owns the ATM may charge you a fee. So a single ATM withdrawal might cost you $4 or more, a substantial percentage of the amount you are withdrawing if you are withdrawing only $20. Then there are monthly maintenance fees, monthly service charges, minimum balance fees charged if your account balance falls below a certain threshold. There are fees for paper statements, though most banks have moved to online-only statements, and waived this charge for most customers. There are fees for cashier's checks, fees for wire transfers, fees for closing your account, fees for numerous other services. Some banks charge fees so aggressively that they seem almost designed to punish their customers. A person with a small account balance, someone who rarely maintains a minimum balance, might pay $50 or more per year in fees, despite being charged no monthly fee. These fees accumulate slowly. You might not notice $50 charged across the year, dispersed in small amounts across multiple charges. But notice that $50 is taken from you nonetheless. When you calculate your actual return on a savings account, when you factor in the fees charged against you and the interest paid to you, the net return can actually be negative. You can actually lose money while your money sits in a bank account supposedly earning interest for you. This, then, is the hidden economy of modern banking, the fees and charges that exist outside the obvious pricing structure, the small drains that together constitute a significant portion of banks' profits. Somewhere in the late 20th century, as computers became more powerful and the internet began to weave itself into the fabric of daily life, a new kind of bank emerged. The online bank. The bank that had no physical location, no marble hallways, no uniformed tellers standing behind glass counters, no vault with a massive steel door. The bank that existed entirely in the digital realm, accessible only through a computer or mobile device. This was revolutionary. For most of history, having a bank meant having a physical location you could visit. But the online bank made physical location irrelevant. You could open an account with a bank thousands of miles away, deposit checks using a phone camera, and access your money from anywhere on Earth with an internet connection. The first major online bank in the United States was called ING Direct, and it arrived in 1996. At the time, the concept seemed almost absurd to many people. How could you trust a bank you could not walk into? How could you deposit money without a teller? The answer, of course, was that the infrastructure of online banking made physical presence unnecessary. Checks could be scanned and deposited digitally. Account management and inquiries could be handled through a website. Money could be transferred electronically between banks. The entire banking relationship, previously rooted in physical presence, could be conducted digitally. What drove the success of online banks, what made them increasingly popular, was simple economics. Online banks had lower overhead costs than traditional banks. They did not need to maintain hundreds of branch locations with expensive real estate, with employee costs, with administrative infrastructure. They could operate with far fewer employees, handling exponentially more transactions per worker. With these lower costs, online banks could afford to pay higher interest rates on savings accounts. The money you deposited would earn more. Simultaneously, they charged fewer fees, because they had lower costs and less overhead to justify charging you for services. Many online banks advertised, "No fee checking," and meant it. No overdraft fees. No minimum balance fees. No ATM surcharges. Just straightforward banking without hidden charges. For many customers, this was revelatory. They opened accounts with online banks and discovered that they were paying less in fees and earning more in interest. The difference was not enormous on a month-to-month basis, but over years and decades, that difference could amount to thousands of dollars. Traditional banks, facing competition from online banks, were forced to improve their offerings. They increased interest rates on savings accounts. They reduced fees on checking accounts. They began offering online interfaces to compete with the ease of online banking. The landscape changed. Over the past 20 years, the distinction between online banking and traditional banking has blurred. Today, virtually every bank, whether online or traditional, offers robust online and mobile banking platforms. The convenience that was once exclusive to online banks is now expected from all banks. Yet the economic advantage of online banks persists. Because they maintain lower overhead, they can continue to offer higher interest rates and lower fees. Many customers now maintain accounts at both online and traditional banks, using the online banks for savings and the traditional banks for checking, optimizing their financial situation by using the strengths of each. The revolution of online banking has, in effect, forced the entire banking industry to become more customer-friendly, more conscious of fees, more willing to compete on service and interest rates. For the customer, this is a remarkable benefit. The existence of online banks, the competition they created, has saved ordinary people billions of dollars in fees and generated billions of dollars in additional interest. It is perhaps the most customer-friendly disruption the banking industry has experienced in centuries. And yet, for all the advancement of online banking, for all the convenience and efficiency of digital accounts, traditional banks persist. The banks with branches, with tellers, with physical locations in your town or city, continue to operate and continue to attract customers. Why is this? Why do people still use traditional banks when they could access their money more efficiently online? The answer is multifaceted, nuanced, and deeply human. First, there is the matter of physical convenience. Yes, online banks are accessible from anywhere with an internet connection, but some transactions still require physical presence. You might need to deposit cash into your account, and while many online banks have relationships with other banks' ATM networks, cash deposits can be more complicated than depositing a check via mobile app. You might need to withdraw a large sum of cash, and while ATMs can do this, some people feel more secure conducting such transactions inside a bank building, face-to-face with a person. Some customers simply prefer the certainty of dealing with a human being, of speaking to someone who can answer questions in real time, who can help troubleshoot problems, who can provide advice and guidance. The personal relationships that traditional bank tellers and managers develop with their customers have value. You might come to trust a particular bank manager, someone you have known for years, someone who understands your financial situation and can provide guidance. This human element, this relationship, cannot be replicated in online banking. Then there is the psychological comfort that many people feel from the physical presence of a bank building. There is something reassuring about walking into a bank, seeing the security, the solid architecture, the uniformed staff, the vault that you know is somewhere in the building. It might be irrational, but it is powerful. Many older people particularly find comfort in traditional banks. They grew up with traditional banking, they understand it, they trust it in a way they might not trust a bank that exists only as a website. And traditional banks have adapted. Recognizing that they cannot compete on interest rates or fees, they have focused on customer service, on personalized attention, on the human element of banking. They have invested in their online platforms, ensuring that customers can do nearly everything online while still offering the option of walking into a branch if they choose. Many traditional banks have actually improved their offerings significantly, because they understand that they must offer excellent service and reasonable rates in order to retain customers who have the option of switching to online banks. The branch network of a traditional bank, while expensive to maintain, is also a significant asset. If you travel frequently, having access to branches across the country can be valuable. If you need to conduct business in person, knowing that there is a bank branch near you is reassuring. Some businesses still prefer to work with traditional banks for operational accounts. Large deposits of cash, for instance, are easier to manage through a bank branch than through an online bank. In some communities, the local bank is not merely a financial institution but a community anchor, known and trusted by multiple generations. The bank manager might serve on the local chamber of commerce, sponsor the high school sports team, be a recognizable and respected member of the community. There is value in this, value that transcends pure financial metrics. So traditional banks will not disappear, even as online banking grows. Instead, they will continue to serve those who prefer them, and they will continue to compete by offering service and convenience that online banks struggle to match. Now that we have explored both online banking and traditional banking in depth, we arrive at a question that you may be asking yourself: which is right for me? The answer, truthfully, is that the right choice depends entirely on your individual circumstances, your preferences, and your financial situation. For some people, a single online bank is ideal. If you rarely need to deposit cash, if you are comfortable managing your finances online, if you prioritize higher interest rates and lower fees, an online bank can provide excellent service at minimal cost. You open an account, you receive a debit card, and you can manage everything through their website or mobile app. The interest rates on savings accounts are often 3 or 4 times higher than what traditional banks offer. The fees are minimal or non-existent. For someone in this category, an online bank is likely the optimal choice. For others, a traditional bank with branches is the better option. If you frequently handle cash, if you value having a person you can speak to, If you want the reassurance of physical locations, a traditional bank is worth the slightly lower interest rates and slightly higher fees. The convenience and peace of mind justify the cost. Still, others find that an optimal strategy is to use both. Maintain a checking account at a local traditional bank for your day-to-day banking needs, for the checks you occasionally write, for the deposits of cash. Use that account for automatic bill payments and electronic transfers. But simultaneously, maintain a savings account at an online bank, where your money earns substantially more interest. When you have accumulated extra money, transfer it from your traditional bank account to your online savings account. The money there earns more, because the online bank passes along its cost savings to depositors. The online bank's customer service is excellent if you ever need it, but you rarely do, because the account is simple. You are merely saving money, not conducting frequent transactions. This two-bank approach lets you enjoy the benefits of both worlds. The convenience and familiarity of traditional banking for your primary account, and the higher interest and efficiency of online banking for your savings. Another consideration is the FDIC insurance limit. If you have accumulated more than $250,000 in savings, you cannot place all of it in a single institution without exposing some portion to risk if that bank should fail. In such cases, you must use multiple banks. You might place $250,000 at an online bank with excellent interest rates, another $250,000 at a traditional bank where you maintain your checking account, and another $250,000 at yet another bank. Each is fully insured, and you are optimizing interest rates across your available options. Or you might use the special coverage categories we discussed earlier, placing money in joint accounts, retirement accounts, and individual accounts at a single institution, structuring it so that all of it is covered by the $250,000 limits. The key is to understand your options, to consider what matters most to you, and to make a deliberate choice rather than passively accepting whatever banking structure you have inherited from your past or from habit. When you make that choice, when you decide what type of banking serves your needs best, you gain a kind of confidence, a sense of agency over your financial life. That is remarkably comforting. You are no longer a passive customer of a bank that has chosen you, but rather an active participant who has chosen a bank that serves your needs. We have now journeyed together through 15 chapters of quiet exploration, through the history of banking anxiety, through the mechanisms of modern finance, through the diverse landscape of contemporary banking options. And so, as this journey draws to its gentle conclusion, as we approach the end of this narrative, I offer you this final thought, this ultimate reassurance. You began this evening, perhaps, with a question, a quiet anxiety about where your money goes, about whether it is truly safe, about whether the institutions holding your wealth might fail or disappear. That anxiety is understandable. Money represents security, represents the fruits of your labor, represents your stake in the future. To entrust it to others, even to institutions, is an act of faith. And yet, we have discovered together that this faith is not blind. It is not irrational. It is, in fact, quite reasonably placed. The systems that protect your deposits are robust, tested, forged in the fires of economic crisis and refined through decades of careful regulation. The Federal Deposit Insurance Corporation stands ready, with the full backing of the United States government, to protect your deposits up to a substantial limit. The banks, whether online or traditional, operate under strict regulatory oversight, subject to regular examinations, required to maintain certain capital reserves, required to operate transparently within a framework of rules designed specifically to prevent the catastrophes of the past. Your money, when placed in a bank, is not sitting idle in a vault, growing stagnant. It is being used, carefully and under regulation, to facilitate the functioning of the economy. It enables homebuyers to purchase houses. It enables small business owners to grow their businesses. It enables development and construction and commerce and the basic functioning of society. And in return, you receive interest. You receive compensation for the temporary use of your money, for your trust, for your participation in this grand system. Your individual account might seem small, insignificant in the vast machinery of global finance. Yet it is important. It represents your future, your security, your independence. And every bank that accepts your deposit accepts with it a responsibility. The responsibility to safeguard it, to protect it, to ensure that it remains available to you whenever you request it. This responsibility is enforced not merely by the conscience of bankers, though most bankers do take their responsibilities seriously, but by law, by regulation, by insurance, by the entire architecture of the modern financial system. If you have traveled this evening with us through the history of banking, if you have learned about checking accounts and savings accounts, about interest rates and compound interest, about FDIC insurance and hidden fees, about online banks and traditional banks, then you have given yourself a gift. The gift of understanding. And with understanding comes confidence. When you understand how something works, when you comprehend the mechanisms and the regulations that govern it, it ceases to be mysterious or threatening. It becomes, instead, something you can work with, something you can navigate, something you can use to your advantage. Your money is safe. This is not a hope, not a prayer, not a speculation. It is a fact, grounded in law and regulation and insurance, grounded in decades of careful refinement and continuous vigilance. If you have deposits with a member bank of the FDIC, your deposits are protected. If you maintain a checking or savings account, you are participating in a system refined over centuries, tested in crises, and designed with your safety in mind. Take comfort in this knowledge. Sleep peacefully knowing that your money, your future, your security, rests in institutions that are bound by law and regulation to protect it. And if you have found this journey through the world of banking to be clarifying, if it has brought you peace or understanding, then please, if you will, consider supporting this channel. If you have chosen to subscribe, thank you for your trust. If you have chosen to like this video, thank you for your acknowledgement. And if you share this journey with others, with friends or family members who might also find comfort in understanding the systems that govern their financial lives, then you are spreading knowledge, spreading understanding, spreading the kind of peace that comes from awareness. But whether you choose to support this channel or not, whether you choose to subscribe or to share, know that the most important thing you can do is continue to educate yourself about your finances. Continue to ask questions. Continue to seek understanding. Continue to make deliberate, informed choices about where your money lives and how it works for you. The world of banking is not as mysterious as it may have seemed when you began this evening. It is, in fact, quite understandable, quite navigable, quite subject to your control once you have developed understanding. And you have now taken the first steps toward that understanding. You have journeyed through the history, the mechanisms, the regulations, the options. You have emerged from this journey with knowledge, with awareness, with a foundation upon which to build more sophisticated financial understanding. And for that you deserve credit. You deserve recognition. You deserve, most of all, the peace of mind that comes from knowing that your money, your future, your financial security, is understood, protected, and working for you in the quiet machinery of the banking system. Thank you for spending this evening with us, journeying through the gentle corridors of banking knowledge. May you sleep well tonight, knowing that your money, your deposits, your savings, rest securely in institutions designed, regulated, and insured specifically to protect them. Good night, and may understanding bring you peace.